If you're a doctor who's looking to save 5 figures or more on your taxes, then this video is for you. Looking to provide more money for your family and start building legacy wealth? Or do you wish you had more cash on hand to get closer to paying off your student loans? Minimizing your tax burden is one of the easiest ways to put more money in your pocket. Not only will this strategy help you save on your taxes, but you'll also be able to grow and diversify your investment portfolio along the way as well. First, let's talk about some of the challenges that doctors face when it comes to taxes. As a high income earner, you're likely in a very high tax bracket, which means you're paying a significant portion of your income to the government. Additionally, if you're self-employed, you may be experiencing some significant self-employment taxes, which can be quite burdensome. And if you have student debt, the interest on your loans, that might not even be fully deductible, further adding to your tax liability. So, if you've ever seen Robert Kiyosaki's cash flow quadrant, you are on the wrong side of the fence. These challenges can put a strain on your finances, making it difficult to build wealth and provide for your family. We're going to show you how investing in real estate can help you overcome these challenges and save a significant amount on your tax bill. One of the primary tax benefits of investing in real estate is depreciation. Depreciation is a tax deduction, allows you to spread out the cost of an investment property over a certain number of years. This can help you offset your taxable income, reducing the amount of taxes that you ultimately owe Uncle Sam. For residential properties, the depreciation period is 27.5 years, while in commercial property, they are depreciated over a 39-year time horizon. That means each and every year, you can deduct a portion of that property's value from your taxable income. To maximize the depreciation benefits, you can consider using a cost segregation study to accelerate that depreciation timeline. Due to the Tax Cuts and Jobs Act, all capital improvements that have a 15-year horizon or shorter, they can be depreciated in year one via accelerated bonus depreciation. Then that can ultimately potentially lower a huge tax bill for you immediately. That strategy leads to substantial savings, allowing you to keep more of that hard-earned money in your pocket. Another tax benefit that you can use in your real estate investment strategy is the 1031 exchange. This powerful tax deferral strategy allows you to defer capital gains when you sell an investment property and reinvest the proceeds in a like-kind property. In a 1031 exchange, you can defer paying capital gains on the sale of your investment property, allowing you to reinvest the full amount of the proceeds in another asset. That can help you grow your portfolio more quickly and ultimately defer taxes and help you build more wealth. To take it just one step further here, it's possible to perform a 1031 exchange through a private real estate fund, which offers some investors unique advantages. And here's how you would do it. When an investor sells a property, they can use the proceeds to invest in a private real estate investment fund through a tenant-in-common structure. Private real estate investment funds, they're managed by sponsors who have experience in identifying and acquiring properties that would meet the criteria for a 1031 exchange. The investors' 1031 funds, they're pooled with additional capital from other investors, and that fund manager uses the pool of money to go out and purchase properties that meet both the 1031 investment criteria as well as the fund's investment objectives. And that allows the investor to mitigate capital gains taxes on the sale of the original property and then continue compounding his or her wealth over the long term. We've created a whole nother video specifically on this real estate professional strategy, so be sure to check that out. Don't forget to like this video and hit the subscribe button for more golden nuggets on maximizing your investment portfolio and minimizing your tax burden, keeping more of that money in your pocket. The tenant-in-common structure can be used in both deal-specific syndications as well as private real estate funds. The advantage of using a private real estate investment fund for a 1031 exchange is that it has the potential to give you a little bit more diversification. You're ultimately investing in a portfolio of properties as opposed to being beholden to one individual asset. But in both cases, the sponsor, they can help you take care of the details of the exchange, making it as smooth a process as you can imagine, just trying to make it more simple for the limited partner, for the investor in the transaction. It's very important to note that there are very specific rules and timelines that you must follow when you're conducting a 1031 exchange. So be sure to consult with a tax professional and make sure that you use a qualified 1031 intermediary to ensure that you're adhering to all the rules and regulations that the tax code provides. Another tax benefit is mortgage interest deductions. When you finance a real estate investment with a mortgage, you can deduct the interest paid on the mortgage from your taxable income. That is known as the mortgage interest deduction. And it's another way that you can use real estate investing to help you save on your tax bill. The mortgage interest deduction, it can be especially valuable for doctors who are typically in a high tax bracket. By deducting the interest paid on your mortgage, you can reduce your taxable income, obviously lowering the amount that you owe in taxes and keeping more of that money in your pocket. Keep in mind that there are limits to the mortgage interest deduction, so again, be sure to consult with a tax professional to determine how much you can deduct based on your specific situation. That might determine how much leverage you might want to put on any given individual asset. But this is the big one, guys. The passive activity loss rule. This is another advantage for doctors investing in real estate. This rule allows you to offset your active income, such as your income from your medical practice, with losses from passive real estate investments. It should be noted that these losses are phantom losses generated by depreciation. Your investment may very well be throwing off cash flow and increasing in value, but you still get to write off a huge tax loss on your tax return as a result of depreciation. In essence, that means that if you have losses from your real estate investments, you can use those losses to offset your other income, which could result in a lower tax liability. However, there are limits and restrictions on how much passive activity loss you can deduct, and certain income thresholds may apply. So again, be sure to speak with a tax professional to determine how that passive activity loss rule applies to your unique and specific situation. Please note, this is a big caveat here, guys. You or your spouse need to be considered a, quote, real estate professional in order to maximize this tax strategy. This is an advanced strategy, and it's a huge benefit for doctors able to implement this within their household. We've got a free gift for you guys. Feel free to download the ebook, The Passive Investor's Guide to Mobile Home Park Investing, to start your journey towards financial freedom. We're talking about taxes. Mobile home parks are remarkably tax efficient, so feel free to use them to lower your tax burden and keep more of that hard-earned money in your pocket.